Only gold is money. Everything else is credit. Everything else is a contract.
Enter the realm of financial enlightenment with Lynette Zhang's illuminating video. In her informative breakdown of the assertion, only gold is money, Zhang guides viewers through the maze of contracts and their associated risks. Join her in unraveling the mysteries of our monetary system for a comprehensive understanding of true wealth. Be sure to stay tuned to the end of this video for an analysis that will blow your mind.
But what I really want to focus on is a lot of people, for tax purposes, have turned to the municipal bond market. And in reality, the New York Fed did a study years ago that showed that no, they weren't really as safe as the perception that people had. And now we need to really talk about it because that market is exploding. And you might not be aware of the hidden dangers. So let's just jump right into it and let's have that conversation. Because there are issuers, rent-a-muni issuers, scored market access for bonds that came out at $1 and are now at 11 cents. Now you have to add a few zeros on there to make that more accurate. But the PFA in Wisconsin has issued debt in businesses nationwide. So you still have advantages in the federal level, but not on the state level as far as taxation is concerned. Okay, let's take a look at this because that was back in 2020. Now, who is the PFA? Well, the Public Finance Authority. The PFA is a political subdivision of the state of Wisconsin created for the purpose of issuing tax-exempt and taxable conduit bonds for public and private entities nationwide. So again, this was an agency that was specifically created to generate and issue more debt for the state of Wisconsin. That's their sole goal, and they can go anywhere in the country to do it. The PFA was set up a decade ago with the sole purpose of renting out its power to issue municipal debt to businesses all over the country, from real estate developers and colleges to nursing homes. So you're buying a municipal bond that you think is safe, but these are revenue bonds, these are conduit bonds. And personally, this is an accident waiting to happen, in my opinion, and also possibly in reality. Because they are one of the biggest bond markets and they have no employees. Last year, 17 of its bond issues, or more than half, didn't have credit ratings. So it's just about generating income for the state. They don't really care how safe it is for the investor. It is a step frequently used by borrowers that are unlikely to receive an investment grade, according to Data Blah. Only qualified institutional buyers, those are buyers that buy on your behalf. That's what institutional buyers are. Or accredited investors, so you have to have a certain level of wealth and income, can buy these securities, and those rated below BBB minus. So you can see, and I got news for you, junk is always junk. My mother always said it's better to have one of the best than 10 of the cheapest. And junk, frankly, is always junk. So what in the world can go wrong? Lots of things, especially if you're the holders of those bonds. Because Bank of America and many others see more muni bond defaults. And part of that is because the revenues on a statewide, countywide, citywide level are declining in many areas, particularly in places like Chicago, etc. So they have a lot of expenses via their pension plans, their defined benefit pension plans, but their income is declining. And guess what? We're seeing that even in the U.S. markets. So does it really matter? Because investors dive into $4 trillion muni bond market, boosting trading volume. Are you kidding me? Look at the volume right there. Highest, well, at least the highest since they started tracking this in 2020. And it's all about demand and supply, but who's really the investor? Is that mom and pop, or is that your retirement funds, your pension funds, etc.? 401ks, IRAs, annuities, all that stuff. Investors rush into the market as yields rose. And now we're being sold that this is a great time to buy and put out duration. In other words, go longer, but this is what happens, okay? Interest rates, current market value. When they issue it, this is when issued, right there. So when they issue it, when interest rates go up, the principal value goes down. This is maturity. You can see how much more the principal declines the longer out you are. So that's what they're wanting you to do right now. Because the reverse is true as well, right? So they're counting on a Fed pivot. Of course, you have to understand what's happening when we get that Fed pivot, but they're counting on a Fed pivot. So then if the Fed pivots and starts to push those interest rates down, you can see what happens to the market value of the bond. As long as the bond doesn't default, then if you hold it to maturity, you may get your principal back. The purchasing power is another story, and that's what inflation erodes. And we know that. We've talked about it a long time. But again, I have to ask this question. This is not the first time I've asked it. Why would you risk your principal for a little bit of interest when you can hold your principal, your purchasing power intact right here in an undervalued asset that has full global demand? Just a thought. Let's take a look at that. Because what you're looking at here is the spot gold market. And it's easy to control it. While the controlled market yet awaits for the ultimate breakout, so it's got to go above here, and it very well could do that even between now and the first of the year. But let's take a look at what's happening in the key dates and rarities. This is the only physical market. There's no paper contracts written against that. So as I've shown you many times, it is easy to manipulate the visible price of a contract, but only gold is money. Everything else is credit. Everything else is a contract. And anytime you have a contract, you are running counterparty risk. And that's the risk of default from the other entity. Because if you don't hold it, you don't own it, this is your best defense with what we're going through right now. Because it's not even so much if you get your principal back. But inflation has shown you that you lose purchasing power value. So even if you get that value back, you hold it to maturity and you get it back, what's it going to buy you? A whole lot less. And that's a guarantee because that's the way the system is set up. So in this is what the 1%ers do, right? Because a lot of the coins in there will go for millions and millions of dollars. This is the category of this coin and the category that I personally work in, which is a lot lower. And that too has had a breakout. So, while we're still struggling to break out in the paper market, what are you listening to them for? Why? They're just lying and lying and lying some more. For them, it's just about a pickup and a little bit of money. But the physical only market, that's where you're finding the truth. And both of them are breaking out, especially the 1%ers that either write the rules or have the ability to influence those that write the rules. They are clearly breaking out in a very large and pervasive way. So I'd like you to just pay attention to what's going on. Don't be suckered in by the lies. It's their job to lie. It's my job to help you see the truth.
Don't miss out on future revelations. Like, share, and subscribe to our channel for regular doses of invaluable wisdom. Arm yourself with the insights to safeguard your wealth. Engage with our community in the comments section below and be part of unraveling the mysteries of our financial world. Remember, only gold is money. Thank you for being a part of this enlightening conversation.